Down rounds, a reality check for startups. Startups are like rockets, full of potential and ambition. They aim for the stars, hoping to break barriers and achieve greatness. Everyone wants to see them soar to new heights, but sometimes things don't go as planned. A down round is one of those bumps in the road, a reality check that can be quite jarring. Imagine a startup raising money. They previously said their company was worth 100 crores, a significant valuation. But now, they're raising money at a lower valuation, say 75 crores. This can be a tough pill to swallow. That's a down round. It means investors are now valuing the company lower than before, reflecting a loss of confidence. Down rounds can be tough. They can hurt morale and shake the confidence of the team. They can make it harder to raise money in the future, creating a challenging environment for growth. But they're not the end of the world. Many successful companies have gone through down rounds and emerged stronger. It's how you handle the situation that matters. Founders need to be transparent with investors, maintaining trust and credibility. They need to show they have a plan to turn things around, demonstrating resilience and strategic thinking. Why do down rounds happen? Startups dream big. Sometimes they get ahead of themselves. They overestimate how fast they'll grow. This can lead to over-optimistic valuations. The market can also change quickly. A new competitor might emerge. The economy might take a downturn. Suddenly, that 100 crore valuation doesn't seem so realistic. Sometimes, startups grow too fast too soon. They spend too much money trying to grab market share. This is called over-aggressive scaling. It can lead to losses and, eventually, a down round. Down rounds are often a sign that a course correction is needed. It's a time to reassess, refocus, and rebuild. Avoiding the downward spiral. Tips for founders. Down rounds are never ideal, but founders can take steps to avoid them. First, focus on building a sustainable business. That means having a clear path to profitability. Second, be realistic about your valuation. Don't chase the highest valuation at all costs. A fair valuation is better than an inflated one. Finally, be transparent with your investors. Keep them updated on your progress. Be upfront about challenges. Honesty builds trust. Remember, a down round can sometimes be a blessing in disguise. It can force you to make tough decisions that will make your business stronger in the long run. Existing investors and down rounds. A necessary evil. Down rounds are tough for everyone, especially existing investors who have put their faith and money into the company. Their investment is now worth significantly less on paper, causing understandable concern. But sometimes, despite the hit, they agree to a down round anyway. Why? First, it's better to have something than nothing at all. If the company goes bankrupt, they stand to lose everything they have invested. A down round, at least, gives them a chance to recoup some of their initial investment. Second, down rounds often come with pro rata rights, which are crucial. This means existing investors get the first chance to invest in the new round, securing their position. This allows them to maintain their ownership percentage and influence within the company. Finally, existing investors are deeply invested in the company's success. They believe in the founders and the vision they have set forth. A down round is a way to give the company the runway it needs to turn things around and achieve future success. Section 5. The view from the other side. New investors and down rounds. New investors are often wary of companies that have gone through down rounds. It raises red flags and concerns about the company's stability and future prospects. They wonder, what went wrong? What caused the company to lose its footing? Is this a sinking ship, or is there still hope for recovery? But savvy investors look beyond the down round. They see potential where others see risk. They assess the company's core business fundamentals. Are the basics still strong? Is the product or service still relevant in the market? Does it meet a real need? Is there a path to profitability? Can the company turn things around financially? They also look for signs of a turnaround. Are there any indicators of positive change? Has the company made necessary changes to improve its situation? Are they taking action? Is the new management team strong and capable? Do they have a clear vision? Have they learned from their mistakes? Are they applying those lessons to move forward? If a down-round company can demonstrate these things, new investors may see it as a buying opportunity. They recognize the potential for growth. They get to invest in a potentially valuable company at a discounted price, which could lead to significant returns in the future. Section 6. Keeping your valuation steady. A proactive approach. Valuation instability can be damaging for a startup. It creates uncertainty and makes it harder to attract investors. So how can you avoid those dramatic ups and downs? First, focus on data-driven valuations. Use realistic projections based on market analysis and your company's performance. Don't let hype inflate the numbers. Second, prioritize strong business fundamentals over quick growth. Build a sustainable business model with a clear path to profitability. Finally, have regular valuation check-ins. Market conditions change, and your valuation should reflect that. Be transparent with your investors and adjust your strategy as needed. Section 7. Down rounds in India. Some recent examples. India's startup ecosystem is booming, but it's not immune to down rounds. Several high-profile startups have faced this reality in recent times. BYJU's, the edtech giant, saw its valuation marked down by investors. Unacademy, another edtech player, also faced a similar fate. Ola Electric, the electric vehicle company, has had its valuation trimmed. Even established players like Swiggy, the food delivery platform, and Vedantu, another edtech company, have experienced down rounds. These examples highlight the fact that even in a thriving ecosystem, valuations can be fluid. It's a reminder for all startups to prioritize sustainable growth and realistic valuations. Section 8. The final word. Sustainable growth trumps inflated valuations. Down rounds are a reality of the startup world. They're not a sign of failure, but they are a wake-up call. Chasing inflated valuations is a dangerous game. It's like building a house on sand. One strong wave, and it all comes crashing down. Instead, focus on building a sustainable business with strong fundamentals. That's like building a house on rock. It can weather any storm. Remember, slow and steady wins the race. Build a great product, treat your customers well, and the valuation will follow. And if you do face a down round, don't panic. Use it as an opportunity to reassess, refocus, and come back stronger.